Florida woman and a major bank were recently sentenced over a merchant cash advance Ponzi scheme. I share this with you not to add to the amount of negative news that you are probably coming across lately, but there are a few key takeaways that I have from the article, and I'm happy to share a link to it if you comment below or DM me on any social media channels. When it comes to fraud and Ponzi schemes, unfortunately, there isn't a way to easily see through those. I offered some thoughts in one of my earlier articles that I'm happy to share with you, or you can find in my online blog or by subscribing to my newsletter. The signs of fraud are not always obvious, and unfortunately you cannot catch them all the time, but there are a few things to keep in mind as you are vetting a potential opportunity. One is the track record of the operator, and that can often be misleading. Think, for example, Bernie Madoff, or think of one of my passive investments that was in trouble that I shared with you about in a prior video and in a prior article. So track record alone is not necessarily an indicator of safety, but when you're vetting the track record, you really want to ask for additional documentation or verify some of the claims that are presented to you. For example, performance of past investments. If it's a more unique business structure, in this case these merchant cash advances, you want to ask for additional documentation, understand the contracts, and if that information is not shared with you, or the person presenting the opportunity to you declines to share that, or maybe you find out that they didn't ask about that information, all of these are potential red flags. Really high returns is another indicator. If it is too good to be true, it is probably not true. I'm not saying that those investments are not out there, but that's where you really want to peel the onion. And what do I mean by that? Follow the paper trail. Follow the paper trail. Understand the underlying business model. How is cash flow generated in this business? Is it supportable? Are these assumptions and claims supportable? Can you validate those through third parties? Really understanding that and asking for financials of that investment, especially if they're telling you, yes, it's been ongoing for many years, track record of 10-15 years. Great, show me the financials, the complete financials, and preferably, and they will be audited financials from a reputable firm, so you can take a deep dive into the income statement, the balance sheet, the statement of cash flows, the statement of retained earnings, and from that point you may require additional financial reports depending on what trends you are observing. But often, right, in those Ponzi schemes, when the underlying business fails, how new investors get roped into those quote-unquote opportunities is by raising capital from new investors to pay off existing investors, who then have great experience because they're getting paid with the money coming in from new investors. And so that scheme unfortunately propels itself in a negative way. So last but not least, I'll say trust your gut. If something doesn't feel right, you don't have to move forward with that opportunity. Better to lose on an amazing opportunity to get yourself into a poor one, because those losses, like a 50% loss on an investment, for example, will require you to effectively double your return on the next one, which may or may not be feasible. So better to avoid losses, as Warren Buffett once said, and move on with the next investment opportunity if your diligence supports it. So I hope you found today's video helpful, and if you did, please like, share, and subscribe, and I'll see you in the next one.